Materiality, the "who cares" clause, the chill pill of the accounting world. This is the only rule in the entire accounting handbook that gives you permission to be lazy. It is the concept that saves us from having to count every single paperclip in the office supply closet. Sit back. This is the one time I will tell you that accuracy is overrated. You spend your whole life being told that accountants are obsessive bean-counting maniacs. You think we lose sleep over a missing $0.02 variance in the bank reconciliation, which, to be fair, we do. But then you walk into a meeting and tell the auditor, "Hey, I found a mistake. We forgot to record a $5,000 expense." And the auditor shrugs and says, ignore it. It's immaterial. Excuse me? You grilled me for 3 hours about a taxi receipt, but you don't care about $5,000? It feels hypocritical. It feels like the rules only apply when we feel like it. It makes you wonder if the entire financial report is just a rough estimate drawn on a napkin. Let us apply this to your car. Scenario A, the beater. You drive a 1998 Honda Civic with 300,000 miles on it. The bumper is held on by duct tape. The paint is 3 different colors. If you get a new scratch on the door, do you care? No. Does it change the value of the car? No. Do you call your insurance company? No. That scratch is immaterial. It does not affect your economic reality. Scenario B, the Ferrari. You drive a brand new Ferrari. It is pristine. You park it in a vacuum-sealed chamber. If a bird looks at it the wrong way and leaves a tiny scratch, do you care? Yes. You scream. You cry. The value of the car drops by $20,000. That scratch is material. The scratch is exactly the same size in both scenarios, but the context changes everything. $100 of damage on a Ferrari is a rounding error. $100 of damage on a bicycle is a total loss. The over-caffeinated lawyers define materiality very simply. Information is material if omitting it or misstating it could influence the economic decisions of users. Translation: if I hide this, would the investor still buy the stock? If Amazon loses $1 million, nobody cares. It is a rounding error. It is immaterial. If they spent their time fixing it, they would waste more money on accountant salaries than the error is worth. But if your local bakery loses $1 million, they are bankrupt. That number is highly material. The stapler callback. Remember the stapler from the capital expenditure discussion? Technically, a $10 stapler is a fixed asset because it lasts 10 years. Technically, we should depreciate it at $1 per year. Materiality says, don't be an idiot. The time it takes to track the stapler costs more than the stapler. Just expense it and move on. We generally use a rule of thumb, like 5% of profit. If the error is smaller than that, we sweep it under the rug. Here is the takeaway. Materiality is the art of knowing what matters. Junior accountants waste days chasing pennies to make the balance sheet perfect. Senior CFOs ignore the pennies so they can focus on the millions. Your job is not to be 100% accurate. Your job is to be relevant. If the number does not change the big picture, it's just noise.